Hey, how's it going? In today's video, I'm going to show you on how my client was able to buy a house for $6,300 out of pocket while also making $24,000 profit. In this video, I'm going to be going over the pre-qualification stage, the home search strategy, and then I'm going to be going over the final numbers for buying the house. To go ahead and start us off, what we want to go ahead and do is we want to start taking a look at what is the pre-qualification process in terms of being able to buy a house. So typically what ends up happening is people don't have six figures of cash just sitting in their bank account. So what do most people need to do? Most people, they need to go ahead and take out a loan. But how are you going to be able to take out a loan? Basically, whenever you want to get a loan for a house, you need to go to a bank, and these banks are going to basically ask for a whole laundry list of things in terms of to see what you qualify for in terms of a house. Now, on the case of my client, what were her finances? Well, she had a 700 plus credit score, $10,000 in assets, and she also had a job that was producing her around $3,100 a month in terms of monthly income. Now, on top of that, the bank is also going to ask what type of debts that they have on their credit. Now, in the case of my clients, they also had a $490 car payment, along with that, a $50 credit card payment. If we were to go ahead and get all those numbers, add them up, and submit that to the bank, she would have been denied. So if we go ahead and take a look at this spreadsheet, here is why she would have been denied the pre-qualification. So here are all the numbers and all the quotes that I got for her. If you were to get that $3,100 income, multiply that by 12, her monthly income would have been around $38,000 a year. Now, when you are doing a pre-qualification stage, you need to go ahead and assume a lot of things. What are the things that we need to assume? Well, first off, we don't know what the homeowner insurance is going to cost, and we don't know what the property taxes are going to cost. So when I initially did this pre-qual, I have to come up with an estimate in terms of what I think these values are going to be for the particular house. Now, when you do find a house, the loan officer should be able to go ahead, get you quotes for homeowner insurance, and also estimate what the property taxes are going to be for the house. Now, if we were to go ahead and move this loan a little bit further, we also need to take into account what are the closing costs. Well, because I already had an estimate in terms of what the closing costs were going to be, I was able to come up with this number. For this particular loan, getting a pre-qualification at a purchasing price of $160,000, the closing costs would have been $14,000, around $600. One thing that you do need to take into account when buying a house, there's two things you have to pay for. You have to pay for the closing costs and also the down payment. So that's why I usually ask, how much money do you have in terms of assets, to see like what we can do for in terms of budgeting and what we need to do to help structure the loan. When I did the pre-qualification, the closing costs are going to be $14,600, and also the down payment was going to be $5,600. Okay, so if we were to add up all those numbers, we also take into account that this is an FHA loan that I qualified her at, where she can go ahead and finance a bit of the closing costs through the loan. She would have had to pay out of pocket $17,600 to buy this house. Now, if you recall, what were the finances of this person? They only had $10,000. So right off the bat, they would have been able to qualify for the house. A loan officer would have told them, hey, look, you're $7,000 short. We can't help you. Sorry. When you go through this industry, there are certain things that you can tweak, and there are certain negotiating points that you can go ahead and use to help you get qualified for a house. For example, the main issue why this person was getting declined was the cash to close, because my client only had $10,000. So typically when you do an FHA loan, the maximum DTI ratio that you can have, it's going to be 57%. She falls under this 57% debt to income ratio, and the minimum down payment that you have to do, or the money that you would have to spend out of pocket, is the 3.5%, since this is an FHA loan. Now, the credit score is fine, we're perfect, and this was the interest rate, 5.625%, that I was able to quote her for that particular time period back in November of 2024. Either way, the decline would have been declined by another loan officer like this. Now, what was I able to do to go ahead and get this person qualified for the house? I am going to be giving away my biggest trick, and it's actually not a trick. This is actually something that is normally done. But if you don't know it, I'm going to go ahead and tell you on how you're able to qualify for a loan by using this air quotes strategy. And that is actually asking for seller concessions. So this is how I was able to get her the pre-qual for a loan amount for a house. The first thing you can see here is the total cash to close is $8,000, which is under the $10,000 that my client has. So she was, air quotes, able to buy this house because she has all the money for the home. What's the main difference here? Well, the closing costs were the same. Down payment was the same. For an FHA loan, you can ask up to 6% in seller concessions, and all that money can go ahead and be used towards the closing costs. So instead of the client needing to spend $14,600 out of pockets for closing costs on top of the down payments, that amount was able to get reduced by the $9,300, which brought her total estimated cash to close to $8,000. Now, what does this mean? The next part of this video that we're going to be transitioning into is the home search strategy. Okay. Now, I was able to get them the, not necessarily pre-approval, but very, very green light pre-qualification with the stipulation of if my client can get this 6% in seller concessions for this FHA loan, then there's a very high probability that this client could probably get the loan, right? However, it's never guaranteed. So what does that mean? Basically, what you have to do is you need to make sure you have a realtor that can help you find a house where the sellers are desperate. And right now, it's probably going to be one of the very, very few times where buyers have the advantage in terms of asking for help to buy a house. If we were to go back to 2020 and 2021, where homes were getting put onto market and being bought up instantly, do you really think a home seller is going to settle with paying 6% to the buyer to help them buy the house? No, that's ridiculous. They're just going to go with the highest offer with the less headaches possible. But because interest rates had been a lot higher since 2020 and 2021, buyers have a lot of leverage because home buyers are a little bit desperate because homes are being on the market for a prolonged period of time. When you're looking for a house and you're talking to your realtor, typically when I talk to the realtor, here's what I tell them. Look, we need these seller concessions. It's a non-negotiable. Okay. So what you need to do is you need to go ahead and try to find houses that have been on the market for a prolonged period of time where the seller has been desperate. Now, when the seller is desperate, then that's when you can go ahead and ask for those seller concessions. Then that's how you're able to get qualified for the house. However, you really, really need to rely on your realtor and their negotiating skills in terms of being able to ask for that offer for the house. So basically, the client was able to find a house and the seller was willing to pay the 6% in seller concessions. And more specifically, she was actually able to find a house for $155,000, and they're willing to pay not only title and also the seller concessions. So it's actually a little bit more than the 6% seller concessions. So here are the details on the closed loan data. So here we can see we have the final closed loan information. Because we had so much in seller concessions, we were able to buy down the interest rate a little bit lower than what we had on the pre-qual. So that is around 0.3% difference. And basically her DTI, what came out to be 54%, which is perfect. The closing costs were $14,600. And here's the difference. So basically, whenever you want to go into contract to buy a house, you have to pay for two things. You have to pay for the appraisal, and you also have to pay for the earnest money deposit. Okay. Now, I'm not a licensed realtor, but I have enough experience to let you know that that's more or less the process of what you need to do. Typically, if you want to go ahead and get under contract, you won't have to pay normally 1% of the sales price of the house to go ahead and lock that contract. Okay. For this particular house, the house was for sale at $155,000. So the seller asked for 1%, or in this case, the seller was willing to accept $1,500 for the earnest money. Because they had that $1,500 earnest money deposit, that locked us into the contract. And then on top of that, I also suggested to the realtor that we should also ask for the $100 in terms of the option period to give us enough time so that once I submit the loan application to the bank, that gives me enough time to go ahead and make sure we get the conditional approval, which we did. I would also ask your realtor to ask for an option period so that you can basically have enough time to get a conditional approval from the lender, and it gives you enough time to go ahead and do all the inspections that you would like to do on the house to make sure that it is in good condition. In total, to get under contract, the client had to spend $1,600, $100 for the option period, and also $1,500 for the earnest money. Right off the bat, that's what she had to spend out of pocket. And then on top of that, she also had to spend money for the cost of the appraisal. Now, if I were to look here, let's see how much the appraisal cost. Okay, right here, the appraisal cost $795 for someone to go ahead and take a look at the property and evaluate the house. Now, how did my client make $24,000 in profit? Okay, this is how they made profit. If you look at it like this, when you put up a contract to buy the house, that is a contract where the seller of the house has to abide by that purchase contract agreement. So the purchase contract agreement was for $155,000. Now, when we went ahead and did the appraisal on the house, what is an appraisal? Basically, the bank who is doing the loan, they send someone to go and evaluate the condition of the house, make sure it falls under the certain guidelines of the loan, and they put a value attached to what they believe that the home value is worth. So when the appraisal came back, the appraisal didn't get appraised for $155,000. The home actually came back and got appraised for $179,000. So what does that mean? Basically, you are under contract to buy a house for $155,000 and the home is actually worth $179,000. So right then and there, just by buying the house with that contract, you're basically making money right there. So that is a super, super good deal. And believe it or not, because we are in a buyer's market ever since 2023, since interest rates skyrocketed, that is actually something that is actually quite common here in San Antonio, where home values are getting appraised for more than what the contract price is. So after we got the appraisal back, we saw that the home was worth more. We did the loan, we did the closing, we included all the credits. They didn't have to spend any additional money. They actually got a little bit more seller concessions. So as you can see here, here's the initial seller concessions of the $9,300. Now, what ended up happening is when the client paid for the appraisal for $795, they actually credited that for the final cash to close when you go ahead and sign. Or the seller gave them a little bit of credit, $38, which is just for paying for the property taxes. And on top of that, the seller also agreed to pay for the title costs. In total, they actually got around $10,000 in terms of seller concessions, which is absolutely ridiculous. So check this out. My client, basically, if they would have gone to another bank or another lender, they would have been told that they couldn't get a house and they would actually need to save an extra $7,000 to even buy a house. But because there are certain ways that you can structure a loan contract, certain ways that you can do the procedure, there are certain methods and certain ways for you to get a house. You just have to take a little bit of extra steps and also negotiating. Basically, when we were going cash to close and the client was going to go ahead and buy the house, they had to bring a check for around $4,700, and the total cash that they had to spend out of pocket was $6,300, where they're willing initially to spend $10,000. So that literally saves them around $3,000 in their bank account. And on top of that, they bought a $179,000 house for $155,000. So if we were to go ahead and get this here, this was the total loan amount that they have in the house, which is $152,000. So we go ahead and do the math here. We get 179 minus 152. They already had $27,000 in terms of equity in terms of the house. So that is absolutely ridiculous. But this is just one example on how there are certain ways for you to structure the loan and give you the opportunity to buy. And those things are literally just understanding how you can use seller concessions and understand that we are in a buyer's market and sellers are willing to go ahead and help you with that. I can only speak for San Antonio because that's where I do most of my business. But ever since November, a lot of deals in almost every single house are offering seller concessions so that could reduce the closing costs. Now, let's take a little bit of a step back. What is the difference here between buying a house in a buyer's market and buying a house in a seller's market? Well, if you recall, and you were around back in 2020, 2021, homes were being listed and they were getting bought for more than the asking price, which is the opposite of what happened here. Okay. What is causing that? Well, first of all, interest rates are higher. Back in 2020, 2021, interest rates were around 2 to 3%. If we were to go and look back at November right now, the interest rate that this client got was 5.25%. Okay. That is a 3% difference. However, what are the trade-offs? First of all, they bought a house that was worth more than the contract price, which made them in total $24,000 profit. Where else are you going to be able to basically spend $6,000 out of pocket and almost quadruple the money that you make just by the equity value left in the house? That happens because right now in the buyer's markets, interest rates are high and the homeowners are getting a little bit more desperate. So they're willing to help accommodate people to help buy their houses. Now, if we were to go ahead and reflect that to a seller's market, if we were in a seller's market, my client right now would not have been able to buy a house at all, because they would have to have needed to save another $7,000 to maybe buy a house. But at the same time, what happened back in 2020 and 2021? Home prices drastically increased. So this same house might have not been worth the same amount. It would have been worth, let's just say, the price value, the $180,000. My client wouldn't have been able to afford the house when it was previously at $180,000, but because the seller dropped the price so upfront, they were now able to qualify for the house. So this is just an example. Right now, if you're a little bit deterred away with the higher interest, I will tell you one thing: homeowners are desperate and they're paying a lot of money to have you help them sell their house. Although yes, you're going to be sacrificing a little bit in terms of interest rate right now, at least you are able to buy the house, get the house under your name, and then you can take advantage of all the seller concessions that you're getting with the house. Now, I do believe that we are transitioning over towards a seller's market, but that is like maybe 3 years, 4 years from now. Right now, if you're interested in buying a house, do certain things that can maybe reduce your interest rates. I do have more videos coming up with different strategies that you can do to help lower your interest rates. So make sure you go ahead and like and subscribe. And this is just one of the many videos I'm going to be making in terms of a success story in terms of my clients and how were they able to basically buy a house with as little money down, and they actually made money buying the house. That is everything that I have for today's video. The main takeaway that I would like you to see is, because we are in the buyer's markets, you can ask for seller concessions and reduce the total cash to close. Trust me, like, you'd be surprised on what you can do. And there's a whole bunch of opportunities for you right now to buy a house. You just need to make sure that you have a good team on your side in terms of the financing and also the realtor. If you need help with purchasing a house in terms of using a loan, please feel free to reach out to me via phone or email. They should be listed somewhere on the screen. And if you also need a realtor in Texas, I can also help you. I do have connections with realtors here in Texas. Other than that, please like and subscribe. And that is everything that I have for today's video.